Hello everybody, welcome to tonight's webinar on business combinations, and we are going to go through kind of a bit in detail on the concepts of the business combinations. It's not just on the business combinations but a couple of the other areas. But before we begin, the copyright standards belong to CPA Canada and other provincial CPA bodies from the CPA Canada Handbook. The interpretations below are my own personal opinion and all rights are reserved. The opinions below are my own and are not to be relied upon. The information provided below is for illustrative purposes only and is not advice or guidance. Learn Formula is not affiliated with or related to CPA bodies. Learn Formula's activities have not been approved or endorsed by these CPA bodies. I just wanted to check in to see if my sound is okay. If you guys can let me know in the chat. And tonight I'm your session leader for the webinar. I've been teaching and doing this for quite a long time and have a good way of helping a lot of people here at Prep Formula, and I really enjoy doing what I do. And tonight is one of those webinars that, to be very candid with you, is pretty difficult and very mechanical. And so I will go through these mechanics with you tonight, okay? So before we begin, we're going to talk about business combinations related to IFRS 3 and ASPE 1582. Okay, thank you. Seems like my sound is okay. But before we begin with that, I want to talk about the resources in terms of improving your technical knowledge for this. And the first thing I do want to talk about is the study guide that's here. Please do email support@prepformula.com for this guide. And what this guide does provide is it goes through the topics specifically here related to financial reporting. And if you go through the financial reporting competency guide and you click this table of contents here, it's going to jump to that location, and it's going to talk about the areas that your analysis needs to include. And also we're going to talk about how to read it talks about how to read the handbook and the important sections that you have to take, rather than reading it from front to back or top bottom, however you want to describe it. And specifically for IFRS, what are some of the key criterion you want to pull for your analysis? And this is what I'm going to highlight here. Now, it's not always the case, but it's a good general rule. And so I want to show you an example of that. So business combinations. So if we go to business combinations, IFRS standards, effective January 3rd, and you'll see business combination, IFRS 3. And if you go through it, right, let's say identifying a business combination. So that's one of the criterion you need to do. You'll have an entity shall determine. So you see how it's bolded here. You've definitely got to pull that into your analysis. All right. And then there's also, some headings here, identifying the acquirer. So here, in order for you to do a business combination, you've got to apply the acquisition method. What is the acquisition method? To go through these criterion here. Now, this is not bolded, right? So that's fine, because you also have these areas here where it's telling you, okay, well, to identify the acquirer, you've got to find one of the combining entities shall be identified as the acquirer. And you see how in the content, specifically, the unformatted stuff, this is more of like an explanation to help guide you. Sometimes it's hard to read, right? Because it's generally written from a legal standpoint. But, part of the skills of what you're trying to go through in the CPA is learning how to interpret this stuff, but also learning how to apply it. So there's quite a bit of knowledge you've got to acquire to use this. Now, specific to this section, I'll be very honest with you, trying to decipher all the details. So this is obviously a section that is written for somebody who specializes in business combinations, goes through the practice, and actually, puts these, I'll say complex financial statements and information together. So it is pretty complicated, a complicated situation. Now, does the CPA exam expect you to go through the similar details and mechanics? They, I think, want you to know from a conceptual standpoint, but they do not need you to know all of the twists and turns and all these various scenarios. So that's what this webinar tonight is really going to focus on. It's going to talk about business combinations with respect to IFRS 3 and 1582. I am going to simplify it for you just so that you understand the concepts, and we're going to work through it, because you're going to see it's strictly a mechanical exercise. And once you understand the mechanical concepts of how to apply it here, it makes applying the handbook criterion and stuff like that much easier, and you don't have to go through the necessary depths of reading these things, because it is, to be very honest with you, quite complicated. Like understanding indemnification of assets and reading it, they're not, this is my opinion, they're not really going to go through testing you on these small little nuances, because it's pretty complicated, just to be very candid with you. And the real world application of this is very limited to generally multinational large companies, and that's not what Canada's base is around. So just kind of sharing my own insights around this, but knowing how to do the initial date of acquisition and those finding goodwill and the non-controlling interest, that is definitely something that they can test you on and have tested you on. And so just to kind of share that detail with you. But when it comes to the detailed working mechanics of after the acquisition, I don't know that they would go to that detail. Okay, so this is sort of the main section. We're going to talk about IFRS 3 and 1582. So if you see the handbook as I'm navigating through it, so the accounting standards, and as you can see, 1582, going back to the ASPE sections, it's usually segregated by the bigger picture areas of the financial statements than the specific areas like revenue or inventory. So you can see 1582 is the business combination section, and it's relatively the same thing. And you see how the formatting that they have here, identifying a business combination, acquisition method. So if I was going through this on an analysis standpoint from a case, I would obviously use case information to describe who the acquirer is, when the acquisition date is, and so on and so forth. Okay, so let's go back to the presentation. So in terms of the business combination, how can you be tested at a very high level? It's provision of advice or assessment of an accounting for a business combination, or evaluation of the accounting treatment used to prepare the consolidated financial statement. The significant issues are determining the cost of the purchase, what is part of the business combination transaction, allocating the cost of the purchase on the basis of fair values, identifying assets, acquired liabilities, assumed that are not recognized in the financial statements of the acquired entity that are to be recognized for the business combination, and then reporting provisional amounts and making appropriate adjustments. So this is what the CFI competency map has described, what you need to know when it comes to a business combination. They don't go through the details that they kind of describe in the handbook. Again, the handbook is what the professional practitioners are using to help them with their unique scenarios, but they don't expect you to know that same level of detail. Okay, so what is a business combination? The acquirer, just hold on, sorry, bear with me 1 second. Okay, sorry about that. So the acquirer, we've got to know who is obtaining control of the business. Okay, the business is obviously an integrated set of activities, but when you're looking through and reading the case, you're trying to find who is the one that is, for lack of a better word, taking control, being the dominant or the parent company, and that's how you've got to use the case information to evaluate who's obtaining control. And the acquirer is identified by considering which entity transfers the cash or the assets, incurs in the liabilities, and issues its equity interest. So when you are purchasing a business, okay, just to kind of be very straight and candid, this kind of ties into finance a little bit too. You're either going to pay cash, debt, or issue equity for it. So who's the one providing that consideration? So consideration is usually those three components, and how is that going? And so who's the one giving that? Okay. The other areas you do want to look at is in terms of who's growing onto the composition of the combined entity, the governing board, who's really driving the business from a strategic standpoint. The other thing, once you know who the acquirer is, which is basically the one giving the consideration of debt, cash, and equity, we've got to determine what the date of the acquisition is when that control happens. Okay, so those are generally the key things you're looking for in a case when you're going through that situation. Okay, now in terms of business combination, there's two ways that it can happen. It's either a purchase of assets or purchase of shares. So I've kind of laid out a chart down here for you to get the summary or details. And again, you guys have these webinar notes, and I definitely suggest that you, let's say, print them out and keep these notes as a handy tool or guide, especially this summary here, to solving the problems that you have. So on the left side, we have purchase of net assets, which is the acquirer records the assets and liabilities purchased at fair value, including the goodwill. Okay, so you're only purchasing the assets and liabilities purchased at fair value. The other is you're purchasing shares, okay, where the acquirer is recording in the books debit investment in the subsidiary, credit the consideration paid, right? And then the subsidiary continues to own its assets and liabilities and maintains a separate legal status, their own financial statements. But we're just talking about the parent company side, okay? So after acquisition, you are then going to consolidate the company after, like, you know, the date of acquisition. Let's say the year end is December 31st. So actually, let me just kind of step back a bit. So the date of acquisition is February 13th, 2020. You are going to record on the date of acquisition the debit and investment, credit the consideration paid. And then when it comes to year end, let's say it's December 31st. So December 31st, 2020, you are then going to consolidate the acquisition interest that you purchased, either 100% or 80% or whatever it is, okay? So that's what the type of business combinations you can deal with. And so when you're going through, here are the steps that you've got to work through, especially when it comes through to your analysis. When it comes to your analysis, the main part is the case discussion is really going to go and cover the, you know, identifying the acquirer, the date of the acquisition. The rest of the stuff is all strictly mechanical and what you would do in your Excel, okay? So let's say here you have, once you've determined the date of the acquisition, determine the acquisition price. So you've got to know how much it was, and usually that's the fair value of the consideration paid, so the debt, the cash, or liability. And there could be other costs included, right? Like transaction costs, like accountant fees, legal fees, whatever. And then the share issuance costs. And that's going to be netted against share capital. So this is what you've got to take into consideration to determine what the acquisition price is. After you've figured out that acquisition price, you've got to analyze the acquisition differential. And the reason why you're analyzing the acquisition differential is to figure out what the deferred income taxes are going to be and goodwill. Okay, so this is what why you're doing it, and you know, we're going to work through that tonight of fair value less book value for each identifiable asset and liability. Basically, any asset that the I'll just say sub or the acquired company is being acquired from, they have a list of their assets and liabilities. So you're going to figure out or be given what the fair value is, and from that fair value you are going to compare it against the book value and subtract the difference and assign the purchase price to that. Once all of the purchase price difference has been assigned to that, if there's any excess remaining, it's going to go to goodwill. Now that's if you purchase 100%. Now, if you purchase less than 100%, you will have what's called non-controlling interest, and you have two methods to apply. Now, this is also part of the discussion that you might need to include in your analysis, whether or not you're using what's called the identifiable net asset approach, which we're going to go through tonight, or the fair value enterprise method. And again, we're going to use an example to show. Now, they do, and it is possible that it could come with two different goodwill, and by choosing these different non-controlling interest methods, or I'll say policy choices, or applications of use, you are going to get two different goodwill numbers. Okay, so that's why this is something you have to discuss in terms of the choice and what is made. Okay, so you know, the secret in these case exams, to be very honest with you, is they are testing not your answer, but they're testing how you're applying judgment. And so anytime you are making a judgment, you've got to provide that reason, and not just some random reason that makes logical sense, but you want to provide a supported reason that is either supported by case facts or supported by the handbook. Okay, so that's why, you know, that's how they're generally testing you. And then obviously they're testing you under a time constraint. Okay, so let's work through a business combination on the date of the acquisition. So there's an example file that was included in this webinar, and so I'm just going to open that up, so just bear with me a second. sorry, my computer is just lagging a little bit and just having trouble moving my mouse. Okay, so here's an example. Okay, Prepmore acquired 100% of Starling's 275,000 issued and outstanding common shares for 1.3 million, and you'll see basically, if we were to do the discussion, I'm just kind of discussing at a very high level first because I want to focus on the mechanics here. Prepmore is clearly the acquirer, right? If we were to go through those steps again, Prepmore is the acquirer. The date of the acquisition, there's no information about when that acquisition has happened, but now we also know what the acquisition price is. And so, for 1.3 million, okay? And, here are the details of Prepmore, here are the details of Starlight. And, I'm just going to give you guys some time to read through this, right? Cash, AR, inventory, customer list, Starlight. So you can see there's an investment in Starlight here. Inventory had a fair value of 423. Equipment with an original cost of 695 and a net book value of 505 and a fair value of 604. The land with an original cost of 265 had a fair value of 189. So all of this information is very similar to what you would get in a case where you would apply and try to solve the assessment opportunity. So this is why we're sort of working through these mechanics here. The customer list had a fair value of 150,000. As the customer list is expected to have an indefinite useful life, Starlight is not amortizing it. The tax rate for Prepmore and Starlight is 30%. So let's calculate goodwill at acquisition and prepare the elimination entry to adjust the opening balance accounts and prepare a consolidated balance sheet. Okay, so this is quite a difficult mechanical issue. So I want to give you guys a little bit more time just to read through this. And what I do suggest is maybe you create an Excel sheet to follow along with the exercise of what I'm going to do. And so I'll just kind of give a little bit of 1 to 2 minutes for you guys to set up on this. Okay, so let's work through first calculating goodwill. So as I read the case, this is sort of some tips that I have. As I read the case, I recognize, okay, well, there's some case information that's given, so I'm just going to type that down. So consideration paid by Prepmore, and then which is, let me just fix the headings on this a little bit, 1.3 million. And then common shares, Starlight. This is straight from the balance sheet that you see here. Okay, so fortunately, I don't know if I can set up two screens. So bear with me 1 second. Case document. Kind of exploring some some new ways with the technology. Okay, so so you can see both sides of my screen now. Okay, and so Starlight, the common shares is 301,000. Actually, let me just move this over on this side. 301, 200. retained earnings. $580, $800, okay. Oops. Okay, so the total here. So what we want to first find is the acquisition differential. Equals 1.3. Subtract these two here. And so, oh, that doesn't work. I've got to do this. Okay, 418,000. And so now we want to assign the, so let me just go through the steps again, just to share with you. So you see here, identify the acquirer, we know, data, so acquisition, determine the acquisition price, which we know. Now we're analyzing the acquisition differential. So the fair value less the book value for each identifiable asset and liability, which was given in the case, right? So we have that in the case down here. And it's fair value differential, inventory, equipment, land, customer list, goodwill. Actually, let me do that. Let me do this first. So book value, fair value. So book value straight from the case. Okay, it's 327,600. So this is all from the balance sheet that you see. 150 equipment is equipment is 505. Land is 265. Customer list is 126. Okay. So just making sure you guys see where I'm pulling all this information from. Oops. Okay. So the fair value of the inventory is 423,600. Oops, 423,600. Differential. $604, 189, 150. Okay. So they Starlight also had goodwill on their balance sheet. Okay, so we're gonna put 45,600. Now there's no fair value because it's just part of the business that you are going to acquire. Okay, so 45,600. Now this is where things get a little bit difficult, which is the deferred income tax. Okay, so I'm just gonna create another section here, deferred income tax. Basis. So to kind of keep a little bit things simple, if I'm selling the inventory at a fair value, like if the fair value is 423, let me just clean up the numbers a little bit. If I sell this inventory, right, it's business income. And business income, it's taxed at a business rate, right? So we want to, like the fair value is greater than the book value, so we are going to get a value for this much, right? Now land, if you sell land, it's considered capital property. And what happens on that capital property? 50% gets taxed. So we've got to take that at a 50% rate. Okay. And then from that, oh, I forgot to do the negative of it. And then times 50%. Okay. So this is what, right now, if we look at the land, the book value and the fair value, so there's a loss. So that's why it's negative, right? And then the customer list is also this one is also at a profit, so we're going to take this times 50%, 24,000, right? And again, customer list is an asset. If you sell it, you're going to get a gain, and in that gain you could take 50%, and that's what you get taxed at. So in total, how much are you going to pay in tax? What's taxable right now? $169,000. Let me just move that down here. And so from that standpoint, remember the tax rate is 30%. And so from that standpoint, here is 50,000. So this is what most people usually have a lot of trouble with when it comes to working on figuring out what the deferred tax income tax basis is. And so I've done that here, and you can see it's actually relatively straightforward. And I try to give a little bit of concepts to explain the reasoning behind that, right? So, you know, inventory, you're selling it at that basis. And now you could argue, okay, equipment should be like that too, but they're equipment, if you sell whatever the equipment is at, it's either capital gain or recapture. And recapture is a catch-up back of CCA, right? So you're just clawing back the CCA, and in this case, the book value was depreciated, and then, you know, it's not really being sold, so it's not really a gain. You're recapturing the CCA that you previously deducted, and you're paying tax for it, land and equipment, so on and so forth. So this is the key thing that I do want you to make sure you recognize. So we're going to take that deferred tax calculation here. And so now this is what our new goodwill is going to be. Okay, so we just add all of this up. Oops. Let me just correct that here. Oops. And so if I take this, subtract the 46,000, we have 371,000 as goodwill. Okay? So after we've assigned so you can see we've worked through that step here. A fair value less book value for identifiable assets and liabilities. You can see those were the identified. The deferred income tax on the fair value differential, and then goodwill. Okay, so we've determined goodwill. So now let's work through the journal entries. So debit common shares, debit retained earnings, debit inventory, debit equipment, debit customer list, debit goodwill. This is gonna make a little bit sense as I'm doing it, okay? And then credit land, credit goodwill, credit deferred income tax, credit investment. And so let's work on those items. So 301, 580, inventory is 96, equipment, customer list, oops, land is, oh, not land, I gotta skip the land, so customer list, and the goodwill. And then here is the land, and then the other goodwill, the deferred income tax, and then the investment that was paid. Okay, so here's the journal entry, and you can see the totals do add up and balance. Oops. 1472300, and then 1472300. Okay. So that was related to A, calculate goodwill at acquisition and prepare the elimination entries to adjust the opening balance sheet. Now let's prepare the consolidated balance sheet immediately after acquisition. Again, this is part of again, another difficult thing that people have challenges with. Okay, so let's go through consolidated balance sheet. Cash, let me just AR, inventory, PP&E, net, customer list, investment in Starlight, goodwill, total assets. So Lourdes, who does the calculation? It is the acquirer or the parent company. And then your second question, is it an asset? You will see in a second. AP and accrued liabilities, long-term debt, deferred income tax, common shares, retained earnings. Whoops. Okay, so here is Prepmore. Here is Starlight. So cash is 144,000, 259, 200, 414, 1656, 0, 1300, 123, 0. Starlight. 114, 123, 205, 200, 327. I'm just copying straight from the question, which you can see. 126, 123, 0, 45, 600. Okay, so this is the part where people will get a little bit confused with. So I'm going to put this part here. Elimination entries, debit, credit, consolidated total. Okay, so inventory had 96. I should do, it doesn't matter. This is 99. Customer list is 24. And then goodwill is over here. And then PP&E, we're going to credit the 676,000, which is up here. Okay. Credit the investment. So we're, because obviously as a parent, you are now creating the combined. So you've got to remove or eliminate the investment. And then here you got the 45,000 from the previous goodwill that was used, which is already embedded right into the the new goodwill calculation. Okay, so I'm just doing the asset side first, and you're going to now see the consolidated total. Okay. Okay. So Lolita, I think you have a choice. You can watch the webinar once it's been recorded to kind of go through the explanations I was going through. In short, you're just paying, because the value that you have on this inventory, you haven't sold it, but the value is there, right? It's unrealized. So if the fair value is higher than the book value, assume you sold it, you would get taxed on that income, right? Like it's revenue and cost of goods. And so you would get taxed on that. But so that's why it's deferred income tax. It's unrealized tax. So once you have that unrealized tax, you've got to consider this is what you're going to pay in taxes in the future based on your tax rate. And then that's just applied across the rest of the balances, okay? So the reason why we're creating that is part of the acquisition of all of the identifiable assets and liabilities so that we can determine goodwill. If you are not including the deferred income tax, you're going to miss this included for your goodwill. Your goodwill is going to be overstated. Okay. So total assets. It's over here. Okay. So let me just reformat this. Okay. Liabilities. 408, 13, 24, 800, deferred income tax, 186,000. Common shares 560, 200. Retained earnings 212,294, 200. So we're gonna eliminate this. Oops. Eliminate this. Eliminate this. And then deferred income tax is the new 50,700. Okay, and then so consolidated totals. Oops, have my formulas backwards here. Sorry guys, it's not really friendly using the online version of Word and Excel. It doesn't help me with my shortcut keys, so I have to key in everything and it's kind of annoying. I'm not used to that. Okay, so you can sort of see, I think I missed something. Oops, overdid it here. Okay, so you can see everything's balanced, which is good. As accountants, we want to have everything balanced. Okay, so let me actually ignore this part. So here is the now revised consolidated totals after working through the necessary adjustments and elimination entries. So this is probably the level of difficulty you can expect to deal with in an assessment opportunity, and this takes a bit of time, right? Like you can see, determining the acquisition differential, working through this fair value differential. The tax part is a little bit hard, right? So this is usually the part people have a lot of challenges with, but hopefully conceptually what I did to break things down and make it a little bit easier for you is good. And then afterwards, you know, the journal entry is here, and then doing the elimination entry. This is probably the maximum of what you would go through in terms of the level of detail. Okay, the allocated differential of 46,700 is not included in the goodwill calculation. It is. So you can see I've summed all of that total and then taken away from the goodwill. Okay, so conceptually, if you have to think about it, you've got to assign whatever the premium you've paid on top of the business. Okay, so the business is worth here 882,000. They paid 1.3 million on the business. Okay, and on that you have a differential of 418,000. So they paid a premium of 418,000. Reason behind that is because if you look at the inventory, the fair value of it is higher, the equipment is higher, so on and so forth. So they've paid it. So we've assigned that differential or that premium to each of these individual assets. Afterwards, obviously, because the value of this is higher than what was initially recognized, there's going to be tax on this in the future. So we've got to calculate the tax to determine if it's a liability or asset balance, right? So we've got some extra tax to pay in the future. And then afterwards, so after we've taken the whole effect of everything, it's a differential of 46,000. So we're going to assign 46,000, and that leaves us with a remaining premium, which is 371,000. So hopefully that answers your question too, Lourdes. And again, you can watch the webinar to go through the mechanics and see how it works. So you can see, guys, this is quite a mechanical thing. It's not like as straightforward as taking criteria, applying the concepts and stuff like that. It's a little bit more towards the mechanics, okay? So let's go back to the presentation. So that was the example file. So now let's use an example where the non-controlling interest, and what I want to show you is the difference between the methods that you use. And this is where you've got to use case information to make that discussion. Okay. So Trump Inc. acquired 75% of common shares of WIG Inc. on this October 1st, 2018. So again, you can see the acquisition date, and you can see the acquisition, who the acquirer is, Trump Inc., for a cash payment of $3.75 million. That's the price paid. The fair value of the identifiable assets acquired and liabilities assumed at the acquisition date was $4.4 million. So the fair value includes an intangible asset with a fair value of $600,000 that was not recognized in the balance sheet of WIG Inc. at the acquisition date. The market price of the shares that Trump Inc. did not acquire was $1 million. Okay, so that was what the 25%. So if I took whatever that market price is 1 million, 25% of that was the 25% is worth 1 million. Okay, so now let's take a look at the mechanics. So the transaction price was paid as 3.75 million. Fair value of the assets and liabilities assumed was 4.4 million. Okay, based on what was given, the non-controlling interest is 1 million. Okay, so that leaves 3.4 million and then goodwill of 350,000. So this is if you were to use the identifiable net assets approach. This is what you saw that I was applying and using. This is what you're doing, and you're given the 25% of 1 million for the non-controlling interest. Now, what if you used the fair value enterprise method? On that method, the identifiable net assets measured at the fair value acquisition date of 1.1 million. So just going back to the slide here, remember what they acquired fair value of the identifiable net assets was 4.4, and what was not acquired, right, was 25% of it. So that would work out to be 1.1 million. And if you were to plug and replace the 1 million, you're going to replace it with 1.1. That makes the goodwill to be 450,000. So you can see there's $100,000 difference between the type of measure you're going to use or the policy for the non-controlling interest. And so this is what you want to make sure you make a discussion and also demonstrate between the two differences in your case analysis if and when you are presented with it. Okay, so when you work through non-controlling interest, one option, most people would just do one of the options based maybe what they're most familiar with. But also, because if you're doing financial reporting, especially I think, okay, if you're doing a CFE exam, my opinion is something like this would show up only on a day 2 and not a day 3, because you can see what I already went through was quite complex and long, right? It's very hard to do it on a day 3. But anyway, so on doing this, part of that additional discussion, and for those of you who watch my other webinars, I always say financial reporting on a day 2 requires very thorough analysis, and this thorough analysis, the difference here is about 100,000, and that's what you want to make sure you are including in the discussion to choose either the identifiable net assets approach or the fair value enterprise method. Okay. Now let's talk about another situation, what could possibly happen, hypothetical. So Tube Inc. acquired 100% of the common shares of FaceLink on November 1st, 2018. Again, you can see Tube Inc. is the acquirer. The acquisition date is November 1st. But there's a provision for the resolution of litigation involving FaceLink that arose prior to the acquisition date, is included in liabilities in the estimated amount of $650,000 and is included in the consolidated balance sheet for the year end December 31st, 2018. The litigation was settled in April 2019, and FaceLink paid an amount of $500,000. So the estimated was $650,000, but is actually $500,000. So what is the appropriate treatment between the provisional amount recognized for the litigation liability at the acquisition date? In accordance, now we're just kind of going to use ASPE. So the resolution of that amount, you will see, so initially it was estimated for $650,000, but instead the real amount was $500,000. So what would happen? If there was an over amount paid for the goodwill is higher, right? Because the liability is higher and they paid a larger premium, if you think about it. So on that larger premium, with a higher liability, that means they were willing to pay a high premium. But because the liability was not as high as it was expected, you would, by December 31st, do a adjustment to, because it was updated, to adjust the goodwill, and basically you're writing down that goodwill to match that lower liability figure. Okay, think of it as it's also fair value update on it. So by decreasing this is how it would happen. You would decrease the goodwill by 150. So when the initial accounting for a business combination is incomplete at the end of the reporting period in which the combination occurs, so this is what GAAP says, okay? The acquirer reports in its financial statements provisional amounts for the items for which the accounting is incomplete. During the measurement period ends as soon as the acquirer receives the information it was seeking about facts and circumstances that existed as of the acquisition, or learns the more information is not obtainable. The measurement period is not to exceed 1 year. So within 1 year, so even though the year end is December 31st, the acquisition was on November 1st, you can still, like, if you didn't get that information yet before November 1st, 2019, then you don't adjust the goodwill. But you have until November 1st, 2019, so 1 year. Once that whole settlement of the lawsuit has come through, then in next year you would make that adjustment, if that makes sense, okay? So you have 1 year to make unknown or undecided information that is still pending to update, and that usually will impact goodwill and potentially taxes, okay? So this is just something for you to recognize when it comes to what's very common. Again, when you guys work through what I was talking about in financial reporting, we're trying to have a very thorough analysis when it comes to financial analysis, and this is part of the subsequent measurement in terms of what I was discussing earlier, okay? Discuss when I would suggest in discussing financial reporting, okay? So remember, we have definition, is this a business combination, who the acquirer is, recognition, when the date is, how much the amount is, so that's recognition and measurement. Subsequent measurement, this is an example of 1 year later, you have 1 year to update any unknowns or estimated, okay? So that's an example of subsequent measurement. Other subsequent measurement includes fair value, acquisition, differential updates and drawdowns and stuff like that, okay? But you know, the after acquisition part is a lot less tested in terms of the mechanics of the details that we went through over here, but they could possibly test you still on these provisional amounts, or at least it's part of the discussion that you have to include to describe within 1 year if the settlement has occurred at a different value, this would impact goodwill. So that's how I would update my response and my analysis, okay? So further, during the measurement period, so again, that measurement period is defined as 1 year, the acquirer also recognizes additional assets or liabilities if new information is obtained about facts and circumstances that existed as of the acquisition date, and if known, would have resulted in the recognition of those assets. So if you suddenly find there's another intangible, or something that you didn't know of, but it was within the scope of at that time of the acquisition, you've got to include it and assign it. So this would also now result in a adjustment into goodwill. Okay, so there's a 1 year period related to how this is all going to play out. So Yulia, yes, I will upload the Excel sheet on the differential, okay? So hopefully that kind of makes sense. I could have taken the whole handbook and taken the snippets of it, but I thought it was much more effective to use a example and work through the concept so you can see how just mechanical. It is simple from an analysis standpoint, right? The points that I've already showed you, that you want to talk about possible provisional amounts, and then also the policy between choosing the net approach versus identifiable net asset approach, or the fair value. That's really the main concern you have to do, and also then know how to do the mechanics. The mechanics are relatively straightforward if you actually understand the concepts, okay? So that doesn't, that comes with some practice. So now this webinar is supposed to just talk about business combination, and you can see it's relatively straightforward for what you need to know, provided you go go through the exercise. It is dense and complex from that perspective, but once you get it, it's not as difficult as you think. So that's why we're going to talk about some things related to subsidiaries, consolidated financial statements, and this applies to IFRS 10, ASPE 1591, 1601, and 1602. Okay, but I am going to go through this relatively quickly because it's mainly tested at a level B proficiency. And so, when it comes to a level B, you have to be able to discuss it. You don't have to go through the mechanics of the details and advise and discuss that apart, but you have to recognize and analyze it at a relatively high level. Will you be tested on a thorough basis? In my opinion, because it's level B, you won't have to be as thorough. So this is the difference between knowing, if you know what is A level versus B level, then that sets the difference to how thorough your analysis will be. And just to kind of draw in the guide again, okay? So you can see in the guide, most of the A-level topics are described here, and you can see subsidiaries are not really discussed, right? Subsidiaries or consolidation and all that stuff. There's no section here. So that's why this guide is to help you improve the efficiency in terms of your knowledge to study. And it's not going to teach you anything, but it's to guide you, right? To know how you've got to approach your analysis and what you've got to include. But if you need to learn the concept, this is what the webinar is for, and the notes that are there for your studies, okay? All right, so very high level, assess what you want to be able to do is assess whether an investor controls the investee, and this comes from using the case facts to help support whether the investor has power over the investee, so who's really controlling the business and who can dictate what is happening, the exposure or rights to variable returns, and then the ability to use its power over the investee to affect the amount of the investor's return. So, maybe they can institute policy with how much profit that they're going to come out with, or the dividends. This is really where who's really controlling who, okay? And other factors to consider is the purpose and the design of the investee, the relevant activities, how decisions about these activities are made. I think, you may not need to know specifically these line-by-line details for this, but you want to be able to recognize, really in general, who has control and the reason why, okay? Consolidated financial statements, uniform accounting policy used for like transactions and other similar occurrences, reporting date. The financial statements of the parent and subsidiaries are to have the same reporting date, so obviously very straightforward, okay? Unless impractical, not possible to do so. And then the non-controlling interest is presented within equity, which makes sense, right? Like, and it's separate from the equity of the owners of the parent. Now, specific to ASPE 1591, control means when an enterprise owns directly, indirectly, an equity interest that carries the right to elect the majority of the members. Okay, so this is how ASPE defines it. And so when you're pulling the criteria, make sure, conceptually you understand who has the power, who has the control, but ASPE is going to use this type of definition: elect the majority of the members of the board of directors, and then the control through factors other than ownership of major equity interests include things like an irrevocable agreement with the owners, ownership of right options that are convertible. So even though they may not have direct percentage control, but if they have some instrument that allows them to convert it to become majority owner, then that's actually, a hidden provision that's saying they actually have the control, right, in substance. And then other control arrangements like management contracts or license agreements. So just be very careful of when you're reading the case, right? You should recognize, here's sort of where my guide is for you. When you're reading the case, you recognize, okay, there's some relationship between the parent, the investor, investee, who has the control, and then you're using reasons why, and in your analysis, you're going to pull these reasons from either who's dictating the control of the business, okay? And this includes things like contracts and license agreements, and you've just got to be aware of that, okay? Accounting policy choice. The accounting policy that is applied to all subsidiaries to be chosen consolidated subsidiaries or account for subsidiaries that are controlled through voting interest. And then consolidate subsidiaries whose equity securities are quoted in active market. This part, I kind of like would suggest you to de-emphasize in terms of what you need to know here. Subsidiaries, you first want to identify the subsidiary and discuss whether the entity controls that other entity. So IFRS control of an investee is based on what we kind of talked about earlier, and the investor has power over an investee, and this again talks about the reasons and what the investor has the power in. Okay, so just pay attention. So one, identify the subsidiary rights that either individual or in combination give the investor power. Okay, and then power with a majority of voting rights. Power without a majority voting rights, you're looking at the contractual arrangements that exist. And then potential voting rights, if there is a convertible instrument that exists, that's what you're going through. So it's just kind of re-emphasizing some of the points. ASPE, the entity owns directly or indirectly the right to elect the majority of the members. So you can see in IFRS there wasn't really that same thing, but as defined in the same way, but it's still, I would still consider it as part of the same case facts, okay? There's really no real major difference. Irrevocable agreement with other owners to exercise voting rights, again, conversion option again, ownership of rights, options conversions, contractual arrangements, and protected rights. So you can see, who controls the power, how do they control it, and really the analysis and what you've got to be able to pay attention to is the case facts to help support that analysis, and you're using the handbook guidance. You don't have to quote I don't think you have to quote the handbook specifically for this. You're just pulling in the case facts to help support who has the power and the control, okay? The next one is on the consolidated financial statements. So number 2, discuss the use of financial statements of a subsidiary in the preparation of consolidation. Most of it is consolidated reporting date. Presentation of the non-controlling interest is in equity separate from the owners, and then measurement of non-controlling interests. So I'm just kind of going through all of the business combination mechanics and details that you have to know about. Okay, so ASPE is generally the same thing. When it comes to accounting policy choice, okay, so determine if an accounting policy choice is to be made for accounting for subsidiaries. Either consolidate all the subsidiaries or account for the subsidiaries that are controlled through voting interest, potential voting interest, using the equity or cost method. This is all ASPE, right? You get a choice. So use of the equity method, very straightforward. And we're going to go through some mechanics of the equity method tonight, okay? And then use of the cost method, the amount of the investment is reported at the balance sheet, whatever the price paid, and it remains unchanged. Okay. So I kind of just needed to go through that a little bit. Now, investment property, I'm also going to go through this at a very high level, just to kind of distinguish the difference between what you're generally dealing with. Now, this is also a level B proficiency, and you just want to know what an investment property is, and you do need to analyze it, but again, not as into the similar depth as a level A, and not expected in terms of the same thoroughness is really what I will say. Okay, when I say thoroughness, just going back to the guide here, just 1 second, you won't be expected to go to the same level of detail through here. I would just touch upon the necessary recognition, measurement. I don't think they would require you to go through subsequent measurement, maybe, right, depending on the type of thing, like if it's a equity method or joint arrangement, or or like some smaller things, but not as major as something at a level A. Okay, so this section is really applied for IFRS only, and the thing is they'll probably ask you some advice or to assess whether or not the investment property is held to earn rentals or for capital appreciation or both, and you're going to talk about the initial cost and then what the recognition is if it meets the definition of a investment property, and then you're going to provide provision advice around the assessment or measurement after recognition, so use of the cost model or the fair value model. So that's generally what you would cover in the subsequent measurement. Okay. So recognition of investment property, it's the probable future economic benefits that are associated with the investment property will flow to the entity, and the cost of the investment property can be measured reliably. Measurement and acquisition is to include costs and transaction costs, very similar to PP&E. Okay, how you would apply investment property in exchange for non-monetary, you're going to apply the non-monetary guidance, right? Specifically to here, which is the measure at fair value, unless the exchange lacks commercial substance or the fair value of the asset received or asset given up is reliably measured. If so, it's measured at the carrying value given up. Measurement after recognition. So this is where most people will miss when they're talking about IFRS, right? Doesn't matter if it's investment property or not. You're going to go through and discuss whether or not fair value model or cost model is chosen. Okay, so fair value model, I think we have a good idea what that is. It's measured at fair value at the reporting date, and you've got to do it when and you can only use it if you have a good amount of information to assess it frequently. Okay. So gain or loss, change in the fair value. You've got to incorporate the fair value in the other, that'll go into other comprehensive income. Fair value of an investment property is not reliable measured on a continuing basis. The property is measured then, therefore, at the cost model, and it's following IAS 16, and its residual value is therefore assumed 0. If you're using the cost model after initial recognition, all investment property is measured in accordance with IAS 16. And then so, at most part, if you are applying IAS 40, right, the similar section you're going to apply is PP&E, right? The only part to be very careful about is the fair value aspect. Mohammed, that guide I mentioned, if you watch at the beginning of the webinar, you can email support@prepformula.com for it, okay? Disposals, no different, right? You're just going to remove it, and any gain or loss is going to go through the P&L, okay? So just kind of relatively going through this relatively quickly because it is a level B, and you guys have the notes for this that you can read through afterwards. Significant influence, we're going to talk about IAS 28 and ASPE 3051. So one thing I want to talk about significant influence, and this is pretty big topic, and I have a summary here for you to take away, which, is probably worth the webinar in itself, right? These summaries. And again, the advice I always share is when you're working through your technical knowledge, try to summarize things up into one page so that you can apply it. And very straightforward, investment, it's really investment in associates. It's when you first acquire that, that portion that you're purchasing, you're going to recognize it at whatever you paid for. And then as long as you work, then you're going to work through whether or not significant influence exists, which goes through either 20 and 50%. And you're also looking at these factors here. So again, these are the analysis factors that you're going to use. And from that standpoint, any subsequent measurement, this is where I'm talking about where you're going to apply equity income for the period and deduct dividends. So I personally think this is possible in terms of the level of difficulty, what they would actually ask you to go through and do. It is relatively a difficult topic, okay guys? So just something to pay attention to. So how can this be tested? This is a level A, that's why it's relatively difficult. You will need to go through the thoroughness of it, so be very careful about it. And basically it's going through and giving advice whether or not the investor is significant influence, and then doing the mechanics of the calculation, which we're going to go through tonight, okay? So significant influence obviously is about voting power, 20%, at least 20%. But the percentage is not really the main guiding standpoint. It's really the evidence of how the significant influence exists, and that can come from representation of a board, doing the policy making processes, material transactions, or interchanging managerial personnel, and providing technical information. So the method that you're going to record is what's called equity method. And in that equity method, that's what your recognition discussion is going to go through. Your definition is going to discuss whether or not it's significant influence, right? So your measurement is going to come through the calculation, okay? And so those mechanics is either first, once you've decided if it's ASPE, right, you can choose either equity or cost method, but IFRS, you don't have that choice. Just something to be very aware about. Okay, so again, just going back to the slides, when there's significant influence, you can choose equity method or cost method, but in IFRS, there is no choice. Okay, so let's work through an example here. Okay, so I'm just going to leave this example up. I'll give you guys about 2 minutes to read through the example and kind of make some notes down, and then we'll work on the example together. So on January 1st, 20X1, Horse Co. acquired 25% of the shares of Cow Inc.'s 150,000 issued and outstanding shares. At the time, Cow shares were trading at $10.50 per share. Cow's reported common shares and retained earnings were $4.50 and $6.25. At the date of the acquisition, Cow's assets had fair value different from their book value as follows. The note, the following is, at the time Horse made its investment in Cow, the equipment had a remaining useful life of 7 years. 1/3 of the land was sold in 20X2 at a loss of $18,000. In 20X3, Cow reported net income of $170,000 and declared dividends of $50,000. The dividends were paid $40,000. Cow reported retained earnings of $830,000 at the end of 20X3. In 20X3, Horse determined the customer list was impaired and it was written down by 30%. At the end of 20X3, Cow had $10,000 of inventory on hand purchased from Horse during 20X3. Horse's gross profit on its sale of inventory is 40%. The effective tax rate for both companies is 30%. So here's sort of the detailed chart of the acquisition, I will say acquisition differentials, right? The fair value and the book value. And, you know, remember how we work through the taxes again, okay? Just to kind of highlight that. And then equipment, land, and customer list. And so here's what we're going to work through: the acquisition differential schedule, calculate the equity income for 20X3, and prepare the journal entry, and then determine the balance of the investment account at 20X3, okay? Okay, so you can see I'm trying to navigate with a screen for you guys, and you'll see the question here. I can't put the other right side of it, so just we'll kind of make note of that as we go through. So so now let's kind of like write down our information. So here is the significant influence. So acquisition differential schedule, purchase price, equals 150 times 25% times 1050. Okay, so I'm just gonna put this on the side for you just to remember. Shares of book value of net assets acquired. 25%, 0.25 plus times 450 plus 625, 268. Okay, so the acquisition differential. Oops, is 125. Let me just clean up the formatting. So you guys can see the concept is about the same for 100% acquisition. So now we're going to do the differential. Okay, so inventory. I'm just going, so inventory, equipment, land, customer list. Okay, so I'm just going to put 25% here, so it's just a little bit easier for me to navigate. So fair value, let me just move this down a little bit. Fair value, book value. So same, just going to type this down. Book value 0. Whoops, something. Oh, right. Okay. Okay, so that's about right. And then we're going to work on the taxes. Whoops. Tax rate is 30%, so I'm just going to put this. Actually, I'll just move that down here. Tax rate 30%. So the kind of want you guys to pay attention how I set this up, right? Like it's like right next to it, so it kind of makes things a little bit easier instead of going all over the place. So now we have the deferred income tax, 15,000. Okay, so if we take the total differential, subtract, oops, yeah. Oh, what happened? Why did it do that? Okay, so here's the revised goodwill. Yeah, sometimes this online Excel really does some funky stuff. Okay, so that was preparing the acquisition differential. Okay, so now we're going to work on the equity income for 20x3 plus journal entries, share of cow's net income, which is 25%. Okay, so how much they earned in 20x3 you'll see is 170,000. So 170, 123 times the 25%. Amortization of the fair value differentials. Equipment, I'm just going to copy some of this down. Actually, no, never mind. Equipment, customer list. So remember, so equipment is 42,000, and their years is 7. Okay, so that's the first bullet point. 6,000. Customer list is 35,000, and we need to amortize that for 30% because it was determined to be impaired in 20x3. Oops. Okay. And then to do the income tax, and then times the tax rate. As you guys can see, right, like if you keep working through these, even just after this webinar, I think you'll kind of get the concept already from how, like, straight, if you set it up very mechanical, you can see, right, it's very modular how I've set it up. I always do this, then I'm going to do this part, the tax is on the right hand side. It's always like, it's the same repetitive pattern, let's say. Okay. Oh, and then at 20x3, Cow had a 10,000 of inventory on hand purchased from Horse, so we actually have to eliminate the unrealized profit. Inventory 10,000 times 10,000 times 40% times the ownership 25% times the tax rate net. Is that right? Yep, 700. So here's the revised equity income. Gotta subtract this because we're eliminating it. Customer list, got this. Let me just format it so it's a little bit nicer. Oh, I forgot the tax. Sorry, guys. Okay, so journal entry, debit investment, 38,650, credit equity income, $38,650. Actually, you're ahead of me, my friend. I'm getting there. So dividends. I was just about getting there. Dividends receivable equals 50,000. Oops. Minus 40,000 times 0.25, 2,500. Debit cash. Let me just write that formula out just so you can see it. And debit cash, 40,000 times 0.25. Again, I'm going to write that out. Credit investment. Oops. Okay, and then the last one, we're going to go through balance at the, balance of the investment account at 20x3. So that's the next part of the question. Okay, so share of increase, horses share of increase in cows retained earnings since acquisition, which is 830,000. Okay, so this is given, right? So 830 minus 625 times 25%. Let me just fix up all these columns first. Amortization, fair value differentials, inventory, equipment, land, customer list, deferred income tax. So inventory is 69,000. Equipment is 42,000 divided by amortization of 7 per year times 3 years, so 18,000. Land is 24,000 times divided by 1/3 over the 3 years. Customer list, it's been impaired, the 35,000 times 30%. And then the deferred income tax, we're taking the 69 half of the land, and the customer list. So sum that. Okay, tax rate. Okay, so this is the total, and the tax is over here. Unrealized profit. $700. So the total equity pickup sum. Oh man, hate that I can't use these shortcut keys. Okay, 14,300. Original cost of investment. $393,750. So investment account balance at the end of 20x3 is the sum of these two. Okay, so again, you guys will have the Excel for this, so you guys can sort of learn from the formulas and everything that I've put together, and hopefully it's organized in a way that's easy for you to pick up. But this is pretty much the magnitude of depth, what you would be expected to perform for a level A in terms of doing. So the in conventional normal financial reporting that you're used to doing, bulk of it is coming from the analysis, the written qualitative part. But in something like this, bulk of this is going to come from the mechanics of the calculation. Okay, so this is just a forewarning for you guys. Okay. So the next one we're going to talk about is joint arrangements. And so joint arrangements at a very high level, just to kind of share with you, there is what's called a joint operation. This is for IFRS, okay? There's two classifications. One is a joint operation, the other is a joint venture. And a joint operator have rights to the assets and obligations for liabilities of a joint arrangement, and a joint venturer have rights to only the net assets of the joint arrangement, okay? And so what is the difference between it? When you're doing a discussion or analysis related to joint arrangements, you're separating. You first got to define which type it is, a joint operation or a joint venture. Okay, if it's a joint venture, you're going to basically use what's called the equity method, which is what we've gone through, and you're going to do the whole thing that the mechanics of what we went through. So now you can see why this is a level A. And the complexities of working through the mechanics of how to do significant influence. Even though it's significant influence, the approach to recording it and accounting for it is the same using the equity method. Now, if the definition falls under a joint operation, so this is a summary, so which is all very good for you guys to take away. There's no investment account, but you're recognizing its assets, including its share of any assets held jointly, its liabilities, including its share of any liabilities. So you're kind of doing what's called a partial consolidation. Okay, it's revenue from its sale of its share of output and its expenses. So you're doing what's called a joint consolidation. There's not really a terminology for it, but like I'm kind of calling it a partial consolidation. You're taking whatever your existing assets and liabilities are, and you are taking your share of it. If it's 30% or if it's 50% of the operations, you're picking it up or you're adding it to your existing balance sheet and income statement. So some small things to notice in ASPE, joint controlled or joint venture, you have a choice to use equity or cost method for accounting, whereas in IFRS you have to use the equity method of accounting for the joint venture. Okay. So how can this be attested? Very high level first. In general, it is determined as a level B, but I think, if you're asked to do an equity method, that's a level A, right? But you can see, in terms of an analysis, my thought process to share with you is, my opinion, is the analysis is really going to be centralized on you focusing on whether or not it is a joint operation or joint venture. Once you've made that determination in your analysis, you're now working through the mechanics of doing it. Okay? So just very high level, what is a joint arrangement? One is two or more parties have joint control, so the parties are bound by contractual arrangement that gives two or more of those parties joint control of the arrangement. The joint control means they're contractually agreed of sharing control of an arrangement, which exists only when decisions about the relevant activities require the unanimous consent. Okay, so again, this is generally, I just kind of want you to recognize the difference between these, and it's the definitions are written down here. So joint arrangements, there's an arrangement that binds two or more, okay, and then joint control, contractually agreed to sharing of control of an arrangement. Decisions require the unanimous consent, okay. So just kind of the notes are all there, and I think the summary really helps put all of the items together. What I want to put together is have you guys work through another example problem and see how this plays out. So again, I want to give you guys a little bit of time to read through the question. I will read it with you, and I'm just setting up the question. So here, example problem. On January 1st, 20x5, Company A and Company B created a joint venture called ABC Co. Company A provided an asset with fair value of $2 million in exchange for a 50% interest in the joint venture. And Company B contributed $2 million of cash to the joint venture. Company A's asset had a net book value of $1.5 million and a remaining useful life of 10 years. This transaction was determined to have commercial substance. During 20x1, the joint venture's net income was $1.3 million, and it paid dividends of $300,000. During 20x1, the following transaction occurred between the ventures and the joint venture. Company A sold $200,000 of goods to ABC at a gross profit of 40%. ABC has 80% of these goods in its inventory at December 31st, 20x1. ABC sold $100,000 of goods to each of Company A and Company B at a gross profit of 25%. One half of these goods remain in the inventory of Company A, and 1/3 remain in the inventory of Company B. At the December 31st, 20x1, all companies have a tax rate of 40%. So let's prepare the journal entries to record the above transactions on the books of Company A for 20x1, and what is the balance of the investment account at the year end. So I'm just going to give you guys a little bit of time to read through and sort this out while I'm kind of setting up my screen for the calculation, okay? Okay, so let's work through this. We're going to have a debit in investment of $2 million. Credit gain on transfer, 500,000 times 50%. Okay. Credit unrealized gain on transfer, another 500,000, oops, times 50%. And then you're going to credit the equipment that these Company A's contributed to. So this is the initial investment into ABC joint venture, okay? Relatively straightforward, straight from the case information, okay? Now, on December 31st. So actually, let me just write up here. This is what's happening on January 1st. December reporting period. Debit unrealized gain on transfer. Credit gain on transfer. So that gain on transfer was 250,000 amortized over 10 years. Oops, wrong side. And then over here, debit okay. Now, I kind of jumped the gun a little bit, but I want to make the calculation a little bit more transparent. So ABC's income. So I'm just going to write some stuff down. So 1.323. Oops. Let me write this down here. So this is on the creation. So unrealized after-tax profits. ABC sold to company A. So ABC sold 100,000 of goods to company A and B. So unsold is 50,000. Profit margin 25%. So unrealized profit $12,500. Let me just fix the formatting. Oh, can't. So there's tax rate 40%. So to make that adjustment is here times this 7,500. Got to eliminate that. So subtract that there. And then company A sold to company B. Oh, sorry, sold to ABC, not company B. Unsold goods. Profit margin, unrealized profit. $80,000. Profit margin 40%. Tax rate. Oops, let me do this first. Tax rate. Unrealized after tax profits. Okay, so now we're just going to clear this out, or up, clear it up. 1.273, now taking the percentage of interest, 50%. And so companies A percentage of interest So now we're also going to do the journal entry to record here. So debit investment in ABC, credit investment income from JV, 636, 636, and then there was a dividend paid of 300,000. So to record share of the dividend, debit cash, 300,000. So this times 50%, and then credit investment in ABC, which is 50% of that. Okay, so again, relatively straightforward, not straightforward, but you have to kind of understand the concepts when you're applying it, right? But once you kind of get into doing it, it's relatively straightforward to get the mechanics of it. And so again, this is what the example is meant to provide. I don't want you to get so lost in the analysis and lose sight of the mechanics behind this. Okay. Let me just expand my slides again. Okay, so as you guys can see, we've gone through some pretty complicated concept problems tonight, and the thing I want you to take away is it's not qualitative heavy when it comes to the analysis of this, but what is heavy here is application of the concepts and trying to calculate based on the case facts that you're given. To be very honest with you, you would be given, if you're given something like this, you're just needing to know where these numbers go and how you go about calculating. And so tonight's webinar really hopefully serves as a model in terms of what you would need to apply if you were given that type of situation. And so definitely use this webinar tonight to practice, right? So as you are watching the webinar, take a look at the question, attempt the question, or pause me, right? Like when you're rewatching, pause me, watch this, and then try to work out the calculation. Don't look at my Excel that I'm going to upload after, right? Like just try to work through these concepts based on what is here, because the concept is really more, to me, telling. It's like pictures are 1,000 words, more telling than and it's more efficient for you to learn through the problem versus reading the handbook and understanding from that standpoint, because it's I think reading the handbook on these topics that are related to the business combination and the significant influence and the joint arrangement, it's really hard to understand it unless you've actually had enough experience. So like for me, doing these problems, it'll give me a better standpoint to then understand the handbook. And again, this is not as qualitative heavy, right? When it comes to the analysis, you're still going to set up, if you ever watch my other webinars, you're going to set up your question or your assessment opportunity with the issue, right? Describing what the issue is. And then your analysis is going to break down in terms of the summaries that I've provided you, right? Like if it's business combination, who the acquirer is, the date, and the consideration paid. Once you've already written that stuff down, you've got to jump straight into the Excel and start working through the mechanics of the case information that's given and solve for those type of things. And that's pretty much where I think you want to be able to get to in terms of that. And this puts it all together for you, okay? So that's really what the intention of the webinar is here. And so, if you have any questions, I hope to see you at my other webinars. If you really liked this webinar, please do leave me a good review and some comments after this webinar. I really appreciate the time that you guys took to attend this webinar, especially this late in the evening, if you're in the East Coast, right? And you know, the topics today is a little bit more drier because it's purely mechanics and concepts, right? And so that's what I wanted to demonstrate in this webinar. And you know, like, it's not it is strictly me pulling out assessment opportunities and just putting it in this webinar for you to apply. So hopefully you guys found this really useful. Again, please leave me a positive review if you like the webinar, and hopefully I get to see you guys soon on the next webinars. And have a good night, and thank you.